Hi, I'm Jimmy. In this video, we're doing an update on Disney stock, ticker symbol DIS. So we're going to kick it off with the basics of Disney's business. Then we're going to look at their most recent earnings. How did they do? Then we're going to try to come up with a fair value for Disney stock using discounted free cash flow. And finally, we're going to try to see, for me on a personal basis, do I buy more shares of Disney? Yes, I currently own shares of Disney. Do I sell my shares here? Or am I better off just holding what I have? Okay, but before we get into that, I just want to tell you real quick about an investing platform that we're building. So we've got our private investing community hosted over on Discord. On Discord, we got a whole bunch of different investing channels where we all talk, share ideas, do some research projects together, and ultimately try to get better as a community at investing. We also do a couple investing live streams, private investing live streams every week. We do a valuation live stream. We do a portfolio live stream where we talk about my portfolio. We build the different portfolios. Plus, we do a research live stream where we try to analyze companies together and go through the process together so we could all get better at it. Okay, now let me tell you about the website that we're building. So we already built the beta version of our discounted cash flow calculator. And the idea is that we would have a website that has a bunch of different valuation methods. So it could be, how do you value banks? How do you value a large cap company? How do you value a real estate company? How do you value a company with no growth or negative free cash flow or negative profits? There's different ways to value all different types of companies. So that's where the website's trying to go. For now, we've already got the beta version of the DCF calculator up there. We're just going to keep adding from there. Now, if you'd like to sign up to get access to our investing community as well as the website, I will leave a link in the description below. But for now, let's jump over to Disney's business segments. So Disney breaks their business into two primary segments. Their largest segment is their Disney media business, and then their smaller segment is their Disney parks and experiences. That represented about a third of all of revenue. Now, in their Disney parks and experiences is things you might expect: revenue from their parks, revenue from their cruise lines, revenue from their theater shows, revenue from the consumer products that they sell. Then their largest segment is their Disney media business. This is the biggest part of their revenue, has been for a while. The biggest part, the oldest part is their linear television. This is more traditional television. Think of things like their ABC channels or their Disney channels or Disney Junior channels, ESPN on traditional cable, that type of thing. That's the revenue that goes here as well. Now, on top of that, within this segment, they have their direct-to-consumer business. This is the segment that's been exciting people the most recently and has the biggest potential going forward. On their direct-to-consumer business, they have things like Disney Plus, ESPN Plus, and Hulu. Okay, now let's look a little bit closer at their direct-to-consumer business. So these four segments came out of the most recent filings, and it is how many subscribers they have in each category. Their largest by far is their Disney Plus category. By the way, the blue bars are subscribers that they had coming into it. Green are the new ads that they had to it. If you were to add all of these up, it's about 220 or so million subscribers, which, if we're curious, puts them about tied with Netflix's entire platform. So they're doing pretty good considering they just launched a couple years ago. But one of the important parts for us to consider here is how much money do they make for each different category? Well, according to the most recent filings, the average revenue per user for each of these groups is broken out right here. This is according to the most recent numbers. Now, one of the important points is that in the most recent earnings calls, Disney announced that they're going to be increasing prices for their streaming products. So we can expect a somewhat of an uptick in each of these numbers. Now, clearly, their live TV and SVOD is streaming video on demand. That is something that if you were to get Hulu and you say, hey, I don't want to pay for cable, I want to pay for live TV, and I'll do it through Hulu or through Disney, that's why that's getting $87 about per month per user. Hulu is coming in a little above 12. ESPN Plus is coming around just a little bit less than 5. Disney Plus is coming a little bit under 4. Now, in the United States, those numbers are much higher. This is the global average, which includes all different platforms. So they have a platform called Hotstar in India. That particular division generates about 58 cents, I believe was the exact number, 58 cents per month per user. So that is dragging these numbers down. But this $391 is the average cost, the average revenue on a monthly basis from their entire Disney Plus platform. So I just think it's important for us to keep that in the back of our mind. Okay, now let's jump over and look at some of their financials. So these are the numbers that came out of the most recent earnings announcement. And the first point to notice here is that we might notice that this is for the close of the fourth quarter 2022. Now that is because they actually end their fiscal year in, I believe, October. Companies can choose when they end their fiscal year. Once they choose it, they have to stick with that generally. They stick with that quarter for a long time. So Disney will always end their fiscal year in October of each year. So I just wanted to bring that out if you're wondering, why is it the fourth quarter and 2022 hasn't even ended yet? That's why. They're already in the first quarter of fiscal year 2023. Just to point that out. Now, the first thing to notice here is the top section. This is revenue. Now, the green bar are what analyst estimates were expecting for revenue. We can see that Disney missed a little bit. They slightly missed. They put up about $20 billion in revenue for the quarter, and the estimated numbers were coming in at 20.5, 20.1, 21, something like that. So they missed ever so slightly. Earnings per share, on the other hand, they had a much more significant miss. Analysts were expecting about 53 cents per share. Disney put up about 30 cents per share. So clearly, this is a big miss. Now, one of the reasons for there to be such a gigantic miss in earnings, but not necessarily revenue, is clearly because expenses went up. Now, Disney has announced and already started putting a ton of money into their direct-to-consumer platforms. We've seen it. That has happened over the past few years, and that will likely continue for at least the next few years. But they've also been spending a ton of money to upgrade their parks. They've been upgrading their cruise lines. They've been spending a ton of money trying to position themselves for the future. None of that is more obvious than when we look at a chart of their cost of revenue. So just so we're on the same page, cost of revenue is what it costs to make the product that you're trying to sell. If we had a lemonade stand as an example, what do the lemons cost? What does the sugar cost? What do cups cost? What does the water cost? Well, that is the cost of generating that revenue. For a company like Disney, well, that would be, what does it cost to make the content that ends up in their Disney media business? What does it cost to build the parks? What does it cost to manage the parks? Things like that would fall under cost of revenue. Well, we can see this enormous spike here because there has been such an increase over the past year specifically. Again, quite obvious right there, the jump from 21 to 22. A ton of money has gone into trying to position themselves for the future, trying to upgrade many things that were a bit on the older side, but again, position them for the future. Now, one of the other important points here is that Disney announced in the most recent earnings call was that they spent in 2022 about $30 billion in content. That's what it cost them to create the content that they make. Their movies, their shows, everything on the Disney Plus platform, everything in movie theaters, things like that. They expect in 2023, they've said it would be the low $30 billion range. So we can see already that's a giant piece of this most recent chart. Now, there is expectations that this number will pull back slightly over the next year or two and should trend a little bit lower, but I don't expect it to return to the original level of, let's say, 2021, because so much money is going to be spent in the future, ideally to generate more revenue. With that being said, let's look quickly at their revenue chart and some of the things that they're doing to generate more revenue. Their primary point that they're doing right now to generate more revenue is, if you haven't already got a notice, if you are a subscriber to Disney Plus, they're increasing the prices for their direct-to-consumer products. Disney Plus, Hulu, ESPN Plus, platforms like that, they're increasing the prices. They also announced that they're increasing the prices to get into parks. That alone should have an automatic impact on revenue. And as we could see here, well, revenue is expected to increase. The green bars are analyst estimates. Revenue is expected to increase over the next couple of years, and it's likely that that trend will continue for a while. Now, it looks like there was a pretty big jump from 2021 revenue onto 2022, but I'm actually ignoring that because 2020 and 2021 were pretty bad years for Disney. Their parks got closed, COVID happened, a lot of things went wrong for a lot of different companies. So for me, I look at this as more of a continuation from their 2019 numbers right onto 2022, and the jump doesn't look as dramatic there. So I think that's a better way to look at this. And then analysts were expecting for those numbers to continue higher. That is true for revenue. But what about profit? So if we were to switch over to a chart on net income. Net income and profit are the same thing, by the way. Well, we can see that over the past few years, the numbers have actually been declining. One of the reasons for that, as we've already talked about, is a bunch of expenses have been increasing as the company has been building their Disney Plus platform, rolling out. They acquired Hulu, more of Hulu in 2019. They have dumped a ton of money in their direct-to-consumer products, as well as additional money into content spend. Now, that is expected to turn around over the next few years. In fact, we can see that analysts are expecting over the next couple of years, profit will continue to increase and gradually get closer to the, call it, pre-direct-to-consumer levels of the 2018, 2019, 2017 area. For us, this is important for us to recognize because we already know that Disney is going to be, they think that they're going to be profitable in the direct-to-consumer business by 2024. So for us, when we switch over to a discounted cash flow calculation, well, we know we want projections to go out at least beyond 2024. So we've elected to go out 6 years here, bringing us all the way to 2028. That allows us to get past to 2024 and let numbers normalize a little bit. So this is a screenshot of the website that we mentioned before that you could sign up to get access to, link in the description below. But basically what we do is we take analyst estimates for free cash flow going out the next few years. In this case, we got 3 years looking forward, and then we have some computer calculations to extend it out 6 years. I'll touch a bit more on that in a second. But basically the idea is, if they were to grow their free cash flow and we discount that back to today, what is that stock worth today? Well, we get a fair value of about $104 per share today. Right now, Disney stock is trading below $100 per share. Now, I'm using required rate of return of 9%. So the way to think about discounted cash flow is that if we paid $104 per share and their revenue, their free cash flow went up along the way we expect it to go, well, we would return 9% per year. That's what the discount rate, that's what the required rate of return is actually telling us. How much will we get per year? Obviously, if we pay less than $104 per share, well, our returns would be greater than 9%. That's where a margin of safety comes in. So if we wanted to, I didn't enter a margin of safety here because I think that that's very much based on an individual's risk and their perception of the company. For me, I'd probably be in the 10% range, maybe 5% range for Disney stock. But that's for each person to customize. So you'd enter that over here. That would adjust the fair value to whatever to account for your margin of safety. Now, some important adjustments that we did make to Disney's calculation is that when we get to computer calculations, anything in black down at the bottom here, well, we have to make some assumptions. The first assumption is how much is Disney stock, how much is their revenue going to grow by? We started at 15% and then it gradually declines from that point forward. If we jump over here, well, we can see that we used a 14% free cash flow to revenue number. Now what that ultimately does is it sets how much revenue, out of the revenue that they generate, how much are they going to convert to free cash flow? We used 14% because when we looked at 2017, 2018, and 2019, well, on average, they had done about 14.5%. I tried to get a little bit conservative, went down to 14%. So it looks like the stock should be worth, according to these numbers, about $104 per share. That brings us to the question, am I going to buy more shares? I do have some shares. My average price is below $100 per share. And Disney, for me, is one of those stocks I want to buy and hold for a very long time. Ideally forever, but hopefully for a very long time. And the answer is yes, I want to try to buy more. As I, gradually put some cash aside for investing, I do intend on picking up some additional shares. At some point, I'll do a portfolio update and let you guys know where my average price has changed to. But as long as it's down here, I'm more than happy to jump in and buy more shares of Disney. This is a stock that I like, that I think for a long time is likely to perform fairly well. Now, if you'd like to sign up to get access to this website, I will leave a link in the description below. Got a link right here. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.